Good afternoon. Thank you for being here. My name is Alain Barbezat. I am a fund manager at Banque Cantonale Vaudoise, looking after emerging markets. I've been doing this for 38 years now. I've seen quite a few ups and downs, and yes, I'm still sane, or so I believe, which is proof that miracles do happen. Before I come to the core of my presentation on emerging markets, I just wanted to basically clarify what we're talking about when we talk about emerging markets. First, in our industry, the world is very conveniently classified into three blocks. The first one being the developed world, the big, well-researched equity markets that we all know. At the other extreme, we have the uninvestable markets, to which Russia gained its membership in 2022. And everything that's in between is defined as emerging markets. Now, there are three categories of emerging markets. The first one being what we call the emerging market long-term, countries that do not have organized and functioning equity markets. We then have in blue the frontier markets, which are countries that do have organized and functional capital markets, but very illiquid and sometimes difficult to access countries or markets. And then in blue here, we have what we commonly refer to as emerging markets. So that's 27 countries. Altogether, emerging markets make up 74% of the landmass, 4/5 of the population, half of the global GDP. But more importantly, the median age of this country is 34 years old. As a comparison, the median age in Switzerland is 49 years old. So they are quite young. And a little anecdote to finish with this slide: you have more people living inside this circle than outside. Think about what it means for the future in terms of where the potential growth can be. As I said, emerging markets represent half of the world GDP. Yet, in terms of market capitalization, they only account for 10% of the MSCI world, the US representing the lion's share of it, about 2/3 of the market capitalization. Beyond accounting for half of the world GDP, the contribution to growth is even more lopsided. Last year, Asia accounted for about 2/3 of the growth in the world, of which China, despite its problems, accounted for half of it. And between 2013 and 2021, China contributed to 39% of the global growth, more than the rest of the G7 combined, which didn't even come close at 25%. So China has been the story over the past decade. But as we all know, growth is slowing. China is having problems. And because the rest of emerging markets have become so dependent on what's happening in China, the whole EM universe has lost appeal with global investors. Should we accept this known fact and go with the consensus? My answer would be a resounding no. Obviously, I'm a manager in this part of the world, so any other answer from me would be you wouldn't believe it. But I'm saying no because we are starting to see another source of growth emerging in this asset class. It's what one could call the Istanbul to Jakarta axis. It's a 10,000 kilometer long corridor, home to 60% of the world population, a region where in 2000 only 150 million people enjoyed middle-class living standards. That number was multiplied by 10 by 2022 to 1.5 billion, and is expected to double again by 2030 to 3 billion people. I'm adding Russia here. Sorry, I'm going too fast. I've added Russia on this map because it's playing and will continue to play a major role in the story I'm about to talk about. But I'll come back to that point a little bit later in the presentation. One of the reasons why China has come under fire from the US is, well, first of all, because it's economically starting to challenge the US, and second, because China is playing an increasingly important role in global diplomatic affairs in some part of the world. Little known is the fact that China has more diplomatic posts abroad than any other country in the world, including the US. And its major diplomatic breakthrough has been in the Middle East over the past 3 years. And this is not by accident. China was behind the Iran-Saudi Arabia peace deal and the reopening of the communication channel between Saudi Arabia and Syria. And of course, well, what's happening in Israel could slow down that process, but it's unlikely to reverse it. So, China is very active diplomatically in the Middle East. Big deal, you might say. Should we really care? Well, since this happened, hardly a month goes by without any announcement of some major infrastructure deal throughout the region. Why is this key? Why is the build-up of infrastructure so important? Let me try to explain it visually. If you have two countries or two cities, you need one link between the two of them. If you have 3 cities, you need 3 links. Nothing to be seen here. But where it gets interesting is from the time you get 4 cities, you need 6 links between this city. If you reach 10 cities, that number goes up to 45, and it goes up exponentially. At the beginning of this century, the world experienced an explosion in growth. It was massively boosted not just by connecting China to the rest of the world, but connecting Chinese cities to each other's. This involved roads, railways, telecommunication lines, power lines, you name it. So it was a multiplication factor, and we know the result. China by itself has contributed to over half of the global growth over that period, over the last 2 decades. Now, imagine that what occurred in China over the past 20 years is now occurring across the entire Asian continent, with many more cities, and as soon will spread to Africa as well. Now, I mentioned Russia earlier, and I alluded to its importance. It's not playing a direct role, it's more playing an indirect role in the sense that in 2022, the US weaponized the US dollar, blocking access to the SWIFT system for Russia and seizing its asset all over the world. So basically, if the US doesn't like you, it will prevent you from accessing your assets and US dollar funding. Without US dollar, you cannot trade. You cannot buy the oil you need, you cannot buy other commodities that you need to make your economy go round. And nobody wants to risk being in that position. Since 2022, Russia has found ways to sell its commodities in other currencies, not in US dollars. These are mostly Chinese yuan or Indian rupiah. Other commodity producers like the Gulf states have found a way around the US dollar as well and are bypassing the US dollar literally at will. Hence, Russia will be the provider of commodities that emerging markets need, that this Istanbul-Jakarta axis will need to build its infrastructure. Russia will provide the the commodities, China will provide the capital goods. We have the blocks. It's a game changer for the entire emerging countries. Think about the world having a wave of globalization which does not require Western financiers, Western engineers, Western financiers, Western technology, for that matter of fact. They can all rely on either Russia or China. Nice story, but it's not just a nice story. We're already starting to see evidence of this happening. The shift is already apparent. Today, China exports more to the BRI countries than to the rest of the world, and it's trading or it's selling its goods more in its own currency than in US dollars. What is the BRI? It's the Belt and Road Initiative that was initiated in 2013 by Xi Jinping. Let me summarize what it is and why it came to be. If you look at China this way around rather than the usual map that we see of the world, you'll see that China is an island. Now, you're pretty sure that I've lost it, but it is a virtual island. It's very geographically constrained. Everything that China produces, it ships it across the seas, either across the Pacific or going around South Asia and the South China Sea. Now, the problem that China has is in front of it, it has US allies, either allies or military bases. So if its relations with the US get to the worst of it, there can be a blockade, and China cannot export its goods. Well, it can go through land, you might say. Well, in the West, they face the biggest desert in the world, the Gobi Desert. They face the Himalayas, and in the South, they face jungles. So you see what I mean when I said China is an island. It's locked. They have two ways out. One is through that narrow piece of land that you have between the Gobi Desert and the Himalayas, which is the old Silk Road. And they can either go by sea, hugging the coastline of South Asia. But that line can still be blocked by the US, which is why, you've probably heard a lot about it, China has annexed and taken over two, I'd say, archipelagos of islands, one being the Paracels, and the other one being the Spartleys from Vietnam and the Philippines. And they've built, guess what, military bases over there, so it can protect that exit should they need to. Now, here's how the BRI looks like seen from above. This already exists. You have a land-based network going through Russia and a sea-bound going around India. Now, obviously, the road through Russia is gone. Nobody goes through there anymore, which is why that Istanbul to Jakarta corridor that I talked about, which is basically here, becomes so important. China needs to be able to go through there should, again, its relations with the US come to the worst. Here's something interesting. I don't need to tell you that emerging markets have been terrible over the past couple of years. They've massively underperformed the MSCI world. Obviously, China has been the main culprit, being down on a relative basis 33%. But even if we exclude it, emerging markets is still behind global equities. Where it gets interesting, is that all those countries involved in that Istanbul-Jakarta axis have outperformed. Some of them very substantially. Turkey being the home of Istanbul, being the exit or being the country that will benefit the most of all that potential trade going through there. The second part of my presentation will be about the biggest markets in that universe, starting with China. China has problems. Nobody can deny it. If you've been to the panel at 12 on China, they pretty much made sure that you were aware of it. Why? Well, the biggest problem is that people have lost confidence and they've lost faith in the future. They are scared, they are insecure. Why? First reason is probably the fact that we've gone from an era where to become rich was glorious, Dixit, Deng Xiaoping, to an era where we were talking about common prosperity under Xi Jinping. It's a huge change in terms of the mindset of the people. The second reason is with that common prosperity drive, the government has implemented changes and regulation in a very badly communicated and very erratic way. Think about the COVID lockdowns, think about the crackdown on e-commerce or e-gaming. People were surprised and it wasn't communicated the way it should have been. And obviously, we have the property market meltdown. Now, I am of the view that this weakness is government-made. It didn't happen by accident. Since 2013, Xi Jinping had been saying, look, property is for living. It's not for speculating. And he started by cracking down on the shadow banking industry, which was the main conduit of financing for property. He was successful by 2019, was job done, mission accomplished. Things had started to stabilize. Prices were starting to come down, but slowly deflate. But then came COVID in 2020, and the whole thing went out of control. Something nobody could have foreseen, obviously, and came at the really wrong time for China and for Xi Jinping. What was designed to be a beautiful landing became a crash landing. And obviously the rest is history. We know what's happening. The end result is that people are not spending anymore. They're hoarding cash. You have on these two slides the cash, the deposits in the Chinese banking system. Since 2020, households' deposits have gone up by 72%. That's $8 trillion. That's the size of the Japanese GDP. It's enormous. And if you net that number out from new loans, the acceleration is even more striking. As I said, property is the major asset of households, accounting for about 51% of their balance sheet or of their wealth. Hence, what happens is major impact on people's confidence. But a fall in property prices is very unlikely to turn into a solvency crisis in China. And the reason being the loan-to-value for property is 16%, not the 80% we have in Switzerland. So people have a very long, very strong holding power, and the banks are pretty well covered. And one example that I can have is when we had the property crash in Hong Kong towards the end of 1990, early 2000, property prices went down 67%. The default rate on property loans was 1.2%. So people can hold on, and they're not at risk of being seized. A very encouraging fact for me is that, yes, new home sales were down 8% last year. And the market focuses on that number because they are the developer's cash generator. It's a pre-sale system in China, and if they cannot pre-sell their development, they risk going broke. But completed new house sales, properties that are not subject to pre-sale and non-delivery risks, were up 27%. Second-hand, we can call that second-hand homes, were up more than 40%. So it's clearly a lack of confidence in the ability of the developers to deliver the good. That's at the core of the strike of buyers in the primary home sales. So I would think that once the survival of these developers is assured, either through balance sheet restructuring or government intervention, we will see sales pick up again. I strongly believe that the Chinese equity market is towards the final phase of a bear market. Have we reached it? Are we about to reach it? Time will tell, but if we haven't reached it, we're very close. It has all the signs of it. The confidence in the economy is at its lowest. News flow is mostly negative. Fear is dominating the markets. Investors have fled the marketplace, and valuations are at rock bottom. Now, somebody said, are they at rock bottom, or are they low for a good reason or not? Now, let's look at them, rather the reverse of it, which is the equity risk premium, which is the equity yield premium over the income yield, the fixed income yield. It's shown here on an inverted scale on the right-hand side. And you can see that every time the premium has reached or surpassed 5%, what happened to the market? It went up. And the only two times when we've been at the current level, i.e. 5% or higher, the market has rallied by more than 100% over the following 12 months. Are we in a different scenario? Are we in a different environment? Slightly, yes, because we have the property market meltdown and all the risks, perceived risks associated with it. But we are rewarded for that risk, unlike other markets. The second market I'd like to address is Korea. Korea has always been cheap, much cheaper than any other equity market in the world, at least in terms of the price to book. And there are good reasons for that. There are, in fact, three main reasons. The first one is that the inheritance tax law has a tax rate of 65%, which means that with such a prohibitive rate, it encourages owners of businesses to keep the value of their asset, the value of their business down in case of inheritance. The second is the dividend tax law, which is 60%. With such a tax rate, nobody is incentivized to go or to push for dividend revenues. And the last reason is the corporate law itself, which states that directors have fiduciary duties to corporates, not shareholders. But things are starting to change. There's a group called the Korea Corporate Governance Forum, which has written a very lengthy letter to the FSC and the Korea Stock Exchange. And basically it can be summarized by, I quote, "Without ending the Korea discount, the youth has no future." Why are they saying this? Seems a little bit odd. Reason being, the pension system will be broke if they can't improve their returns, either through capital appreciation or dividend revenues. We often hear about Japan, China demographic problems, but Korea is even worse. The fertility rate, as you can see here, is 0.72. China is at 1.3. Japan is at 1.2. As a reminder, anything below 2.1 means that your population is about to shrink. It's the 2.1 being the natural replacement rate. I believe that this initiative has, to boost equity valuations and returns, has a fair probability to succeed, which was not the case 4 years ago. Why? Because 4 years ago, only 15% of the population was invested in the stock market. And politics had no interest in using the stock market as a vote-buying machine. By 2022, that percentage had gone to 34%. About 15 million people are now invested in the stock market. About the same number as homeowners. And the property market has always been used by political parties before elections for buying votes. And there's no reason why, because there are so many people invested in the stock market, that they will not do the same today. I change those old laws that were more for protecting corporates rather than, giving a source of revenue for the population. Japan has gone down that road already with their name and blame program over the last 3 years. It's an initiative to quote-unquote encourage companies to bring the value of their company above at least 1 time book value. Korea can use their roadmap, and hence it can be implemented much faster than it has been in Japan. Again, it took 3 years in Japan to really catch up, and it really started to gain traction at the beginning of this year. As a bonus, this comes at a time when we're starting to see a global synchronized pickup in growth. Korea being one of the most, if not the most sensitive country in the world to economic cycles, it can doubly benefit. And if the AI theme continues to develop, the 2 biggest component of the index being Samsung Electronics and Hynix, which make half of the MSCI Korea, will benefit as well, giving it, a third engine. So I believe a lot of potential catalysts for that particular market over the coming few quarters. Saudi Arabia is a market worth following very closely as well. As we saw, it's playing a major role in the Istanbul-Jakarta axis theme, but it's also a country in complete transformation. For the first time ever, last year, the non-oil related activities were more than half of the GDP. We perceive Saudi Arabia as an oil producer, and that's it. That's pretty much what they were in the past, and that's pretty much where they don't want to be in the future. And for that, about 4 years ago, they implemented a program called Vision 2030, articulated around 12 main axes, which aims to, diversify the economy away from oil, which is exactly what they're doing. We are at the very early stage of that transformation, but if they're successful, it's a country that we will hear and talk about much more in the future. You can believe that. And finally, we have India. Beautiful story, absolutely great story, but at the wrong price at this point. Valuations are way too expensive, and I believe carry too many risks. One of these risks being the fact that retail investors have jumped into the market very aggressively over the past 9 months, which is never a good thing in the short term. Another risk, much more worrying, is politics. Mr. Modi is doing great things, done great things for India since 2014 when he came to power. He basically delivered the goods. He was the governor of the province of Gujarat, which had become the most successful province in India. And when he was elected, people expected him to do the same for the entire country. And economically, he has. He's done the right things. But he is also behaving more and more like a despot. He's arresting opposition members. He's threatening journalists and anyone who criticize him. And he's also a nationalist who's dividing and causing religious tensions. And we know India's past. That's something you don't want. It can flare up very quickly. So, again, at current level, I don't think we're properly rewarded for the risks that we take, unlike China. And I will end with this slide that summarizes where we think we are in the respective cycles in different countries or main markets in the emerging market world. China and ASEAN are at the bottom. Their fate is about to turn if they haven't turned already. And they're the best place. Saudi Arabia, Korea, Brazil, and Taiwan, in that order, are definitely the best place in the cycle. Things have already turned, but we are at the beginning of that turn. And finally, countries where we don't really like to be are India and Mexico, because they are at the opposite end of China and ASEAN. They've had a beautiful cycle, but things are starting to look, we're a little bit out of oxygen at those altitudes. Why Mexico up there? Yeah. Because it's benefited enormously from the tensions between China and the US. And a lot of the production has been relocated to Mexico to bypass. This same goes for Vietnam. Vietnam has been a great story, but people have to realize, if you look at the exports from China and the exports from China to Vietnam and the exports from Vietnam to the US, they go hand in hand. So basically China is exporting to Vietnam and then it's re-exported to the US. And it's been the same in Mexico and some other countries like Kazakhstan or,
But this phenomenon that you refer to, nearshoring, as they call it in Mexico, a lot of the beneficiaries of that investment are not traded in the stock market.
They're not?
They're not traded in the stock market.
No, but
it's just FDI, foreign direct investment.
Absolutely, but it improves the economics of the country tremendously in terms of money coming in terms of trade balance, current account balance improvement. So it's more of a top-down story than a bottom-up story in saying, you know, oh, that particular country or that particular sector benefits from, because there's not many production taking place in these countries. So it's just goods going through being imported and re-exported. So, you know, Mexico has done extremely well, not because earnings have exploded, but, you know, because inflation has come down, interest rates have come down, public finances have improved. Those are the main reasons behind, you know, Mexico's good performance. Same goes for Brazil, you know, and these two countries. What could save? When I say save, is, you know, provide a cushion to Mexico and to some extent Brazil, is that their interest rates, their real interest rate, is still extremely high. You know, they were among the first to raise interest rates when inflation started to go up. And as inflation has come down, they've been very slow in lowering rates. So the real interest rate is still very high. So there is some potential in terms of valuation.
So you talk about currency, that there's a kind of a shift a little bit, more transaction in renminbi, especially for this acts of Russia, Iran not trading US.
Yeah.
The BRICS have kind of say that they don't want to compete on the US, they will not launch a currency, or do you see like a kind of an alternative to the US dollar? Or?
It's, I make a, not a comparison, I lost the word, but it's like, you know, the US is Microsoft. Emerging markets or China or the BRICS are Apple. Apple, towards the end of the 1990s, early 2000, realized that they could never compete against Microsoft. You know, Microsoft was there, it was installed, like the US dollar is there, it's installed.
At the corporate side, on the corporate side, not on the, you know, B2B business, yes, Apple was not competing, but B2C, they started.
Well, what exactly, I mean, you know, Microsoft was, what were computers in the late 1990s? It was for corporates. You and I, you know, I had my first computer in 1994, but, you know, among my friends, I was the first to have one.
Windows 95 then.
Yeah. So, you know, Apple was trying to compete against them and have their computers sold to the corporates. And they realized they will never, ever displace Microsoft. So, you know, what they did is they looked at the consumer. And they came with the iPhone and, you know, the design, the sleek design of their computer, make things simple. And it worked. You know, they challenged Microsoft, but not on their own territory. And they became very successful. The US dollar is there. I mean, it's the reserve currency. It will not be displaced, at least, I guess, not in my lifetime, maybe in yours, but not mine. And the BRICS are coming together and trading in their own currency to bypass the US dollar and have their own, basically, trading platform and trading system. Now, you need one key ingredient, is a stable currency, a stable yuan. And the yuan has been extremely stable on a, you know, trade-weighted basis. It's been very stable against gold, against most of other assets. It has a challenge for the past 12 months. It's Japanese yen, because China, you know, has gone up the value chain and is competing more and more with Japanese goods. So, you know, we know what happened to the yen. It's extremely weak, so they're losing competitiveness against Japan. But this and against Korea, because Korea is following the yen again, also because they're competing with Japan. But China has decided not to go down that road, and they've kept their currency relatively stable. And that's the key. If China was to devalue its currency, forget about my story. People will not trust the yuan, and they will go back to the US dollar. So it's not, it's not,
Geopolitical game and
it's a battle.
obviously
It's a battle, and it's a battle that gained traction for the past 2 years. Why? Because of what happened with Russia. If you displease the US, obviously Russia has displeased more than just the US, it's displeased the whole world, but they're trying to do the same with China. You know, they're painting China as the red devil on the walls across the EU, across the US. In the US, the most hated country or the most hated people are the Chinese before the Russians. So what I want to say is, you know, you've had one country that had to suffer the mighty US, and all of a sudden, all the assets they had parked in US treasuries or in bank accounts or other assets disappeared. They were taken over, and they couldn't trade in US dollars. Do you want to be Saudi Arabia? And today, your relationship with the US is okay, but you've had a war against Yemen for a few years. You might do something that displeases the US or the country, and go down the Russian way, saying US dollar, you can't touch it anymore. Your assets that you have all over the world in US treasuries, gone. You want to be China with 1.8 trillion US dollars in US treasuries, being told, bye. $1.8 trillion gone. You cannot have it anymore. So that's the main reason why people are trying to find a way to be able to survive out of the SWIFT system.
Recently, several BRICS countries or new member of BRICS countries decided to launch currency backed by gold instead of US dollar. And they have also been talking about a blockchain-based payment system.
Yep.
So we have the impression that it's a bit the other way around, that the US will have a problem to catch up with the evolution of the BRICS.
I agree with you. And the first country that said, you can trade in my own currency. You can either, if you trust me, keep your proceeds in my currency or have it converted in gold. China, 2014. These countries are backing their currency against gold. If others are doing it, it's because China is doing it. And for the central bank's digital currency, I hope it doesn't happen because it opens a door that we don't want to go through. Today, governments can, if they want, already prevent you from withdrawing your money from the bank. Today, they will be able to tell you cannot spend it on this or this or this. So, yes, it could be a way, but I hope we don't go down that road.
Last week, we had the Gold Conference here in Zurich, and one of the key speakers was talking about the way China was accumulating gold. Forget about the 8,000 tons that Fort Knox has. We have about between 20 and 40,000 tons
Thank you.
to back up the currency. And holding, like you said, 1.8 trillion of treasuries, that would make me a bit nervous. So you have to either diversify or look towards to the debt trap that the United States is falling into because of the debt servicing obligations that it has. And the yuan, if it's backed in that way, would be an alternative
Yep.
as a reserve currency.
Absolutely. I cannot agree more. People, I think a yuan at 5, it's 7.2 now, a yuan at 5 is more likely than a yuan at 9. Over the next 5 to 10 years, we're more likely to see an appreciating yuan rather than depreciating yuan.
We have time. You can ask Alain everything you want at our booth because I see there's plenty of questions. I have a question too. That's the next waiting. So please come down.
Thank you very much.